There it goes. And then what I'll do is I post these recorded sessions at the end of the session. It has to render for a little bit depending on how long we go, and then I'll post it to the website. So what I wanted to do this evening, I just wanted to run you through sort of the course, a little bit about me, sort of address any concerns you might have. This is a very compressed course. There's a lot of material, and I really try to keep the most important parts that I think are important, of course. And really just trying to find a way to get you through the course successfully. That's really the whole goal here. And so I'll walk through the course outline. I'll walk through Moodle. I'll walk through the email system. I mean, I know a lot of you already have navigated that, and that's fine. But there are a few that have not. So I just want to let you know where I will be posting all of the resources for you. But I usually open up by just throwing out the questions. Does anyone have questions of me? Normally I have people ask me questions about my background or what brought me to UCW or what else I've asked. So does anyone have any questions or of me of the course or the just general information? What are you most curious about? I know you already look me up online. Just kidding. I'll give you a little.
Yeah, I think this is the first session, so everyone is waiting to start, and then I'm sure the questions will come up.
They will definitely come up. Yeah. So just a little bit about me. I have been teaching for about 15 years now in post-secondary. I have been sort of all over a few post-secondary institutions in BC anyways. I teach now full-time at Vancouver Island University, which is on Vancouver Island in Nanaimo. So I've been teaching there for 15 years, no, about 14 years there. I did go and teach in Victoria for about 3 or 4 years at Camosun College and University of Victoria. And then when I came back to Nanaimo to teach there, I picked up a couple of more engagements. So I do teach at UBC as well. I teach mainly their tax course for them and their management accounting course. So I'm kind of all over the place. I also do contract work for CPA BC, which is basically CPA West. And I do contract work for them in part of their professional education program. So a lot of candidates that are going into accounting must take the 2-year program, and that's what I teach in. So I'm sort of spread out in many different places. I'm also working on my doctorate. I'm trying to get that done. I'm hoping to have it done by next September, hoping to defend by next September. And I also do some contract work for as a CFO in near Vancouver, near downtown Vancouver, for a startup company that is scaling up their business quite rapidly. So yeah, that's kind of me in a nutshell, I guess. I have 3 boys at home and they're older, so it's easier to manage now. They're not as young as I wish they were, but you know, they're still around, which is great. So my youngest is still in high school, so the other 2 are out of school, or they're in post-secondary. But anyways, that's me in a nutshell. And if you have any questions about any of that, please let me know. I spent a lot of my career before teaching as a compliance auditor for the federal government. And so I did a lot of tax compliance work for about 9 years. And that was really the bulk of where I did all my practice. So miss it. I love tax and that's why I teach it, but I certainly don't miss the compliance part. Not that I wouldn't be able to do it, but I just prefer to teach instead. So it's much more friendly. Not so contentious sometimes with people that don't really want to see you at their door looking through their books and records. So anyways, so what I'll do now is I will share my screen with you. I want to go through a number of things this evening. And maybe what I'll do first is I will just sort of give you a sense of where I probably want to go first. Let me just see here. I'm not sure that that's what I want to start with. Hold on a second. I'm just going to do something really quick. I've learned this little trick here for my Zoom, and it seems to work every time, except when I need it to. But anyways, we'll get there. It's, here we go. There we are. Okay. So I did want to share the screen with you in terms of, someone said to me that they weren't sure about Moodle. So I'm sure that most of you are in Moodle, or at least in that platform. I'm really not sure if that is the case. So I just want to go there really quickly. So I'll just share my screen with you. And so all of my communication, if you're emailing me, please email me through Moodle. My UCAN West account has never worked. And I don't know why. It's a simple thing to register for, but it just never seems to want to work on a regular basis. So I stick to Moodle. It seems to be all contained in one place, and it's a one-stop for me. And that means that I won't miss your email. It gets buried in other accounts. So this is where I'll receive the messages. And then if we go into Moodle, Moodle is okay, but it's somewhat restrictive for me. I don't know that this is really my favorite platform, but I'll work with it. I've worked with it for a while, so it seems to be going so far so good. So what I'll be doing is I'll be going through each of these weeks. We'll be going through these. This is where I'll post all the resources. You'll see that the slides are already here. Those are not mine. I haven't carved those out to be specific to any seminar. So those are from the book, the first edition. And they're completely useful. If they help you, great. If not, that's okay too. If we're face-to-face, I don't normally do PowerPoints. I like writing on boards and having discussions. But the PowerPoints work really well for this platform, and I'm quite okay working with it. And so what you'll also see here is the course outline and the Wiley Plus access code. So this is the Wiley Plus you're asking about earlier, Jessica. So what you'll have to do is log into the Wiley Plus, and your course ID is here. So that document is for you. You'll have to find, if you just go to this, I think this link works. So you just go to your link here and then click on the course ID, and you should find the course, and it should let you in. And then if there's help, just call the support line. They're actually very responsive. They've been really, really helpful, and they're a good group to work with. So if that course code does not work for you, please let me know, and I will touch base with book rep. But this site is really helpful because it has everything that you need in it, and I will be assigning homework assessments out of it because we're so compressed for time. I think it's probably the easiest for us to do in this next 8 weeks. So please make sure I'm going to give you a bit of time to do that and register. And then once I know that everybody's in there, I'll start creating the assignments. And they'll fall in pace with the, the course outline, which we'll go to next. So that's in the first week. And then the course outline, I modified it a bit for this 8 weeks. It was, like I said, really difficult because there's just so much great content, and I could just go on forever. But I think I got it to a point where I really am happy with it, and I think it will work. The downside of that is that you guys are going to be doing a lot of work. But what you will find with the book is that the chapters are fairly short. They're not extensive, with the exception of maybe 2. But they're quite user-friendly. They are shorter. They're full of more visuals and text, so it kind of helps with the understanding of the material. So it does help. The first week here, this is where we are right now. And so you're like, oh no, 3 chapters. It's okay. Because, actually, I'm just going to put you on mute here. It's okay because what happens is they all kind of link together. They're not really outside of the discussion. So what you'll find is they start laddering on each other. So they're not individualized chapters in terms of separate material, but they are, they complement each other very well. So it seems like a lot of reading, but actually they're quite connected. So this goes on. So we have like 2 chapters per week, but that's okay. You guys can manage it. We have ways of doing this. I know it seems like a lot, but you'll be fine. I have good plans for you. And then, so you'll see that week 4, we're at the end of this chapter. One thing I want to say here is that on the way to week 4, we will actually be doing financial analysis. So you'll already be familiar with it up to that point. So when chapter 9 hits, you'll be half of that chapter is familiar to you. So you're not having to relearn anything. There's a couple of new things in there, but you don't have to relearn it. So that's one good benefit of having that. And I haven't decided what the exam looks like yet in terms of when, and probably a weekend, of course. It seems to be a better fit for everyone, and it gives you more time to put into studying for it. And then after the midterm, after week 4, what we do is we transition into the managerial accounting. I love teaching management accounting. I think it's great because there's no rules and you can do whatever you want with it, depending on the business. So we go all the way down to week 8 with that. So we see quite a bit of material here. But it's chapter 16, we just parse some of the things out from chapter 16. It's not all of chapter 16. And I do that with all of these chapters where we're just kind of parsing things out. Basically trying to hone in on the really important parts of this material. We can always look at things in detail. We can always extend the discussion, but given the 8 weeks, I really want you to be able to, when you finish this course, walk into an environment or another class where you'll see this again and actually have a pretty good, solid foundational knowledge of it. No one's expecting you to walk out and know absolutely everything. Probably impossible, but at least you're familiar with the language. You have a voice at a table if this is being discussed and you understand what's being said. The experience comes later, but really just trying to prepare you for that situation where you're having to, comment on things, et cetera, that deal with accounting anyways, financial or management accounting, or having to make decisions that include that. So this is sort of the breakdown of the assessment piece. The Wiley Plus will be the homework. The first midterm, or the only midterm, will be financial accounting. The managerial accounting will be the final exam. And I'll put out a case study for you that encompasses a lot of the material that we cover throughout the course. So you can probably expect that in week 3. I'll give you a bit of time, to sort of catch your pace and become more familiar with your new routine. But yeah, I don't want to give that out too soon because it just adds to the stress of knowing you have one more thing to do. So that will come in time. So that's sort of my plan for the course. And how I plan on doing that is through a combination of things. I have, Wiley Plus actually is quite extensive. It has so many great resources, as I've talked about here. There's videos, there's flashcards, there's practice questions, your assignments will be based in there. And the great thing with Wiley Plus is that it's anytime, anywhere. And there's just that platform of instant results. So you can see where you're at with that. Normally I give you 3 attempts for the homework. So if you're not having a good day, or you maybe thought you had enough reading done, but you need to do more, then you can certainly go back and revisit it. So that option is always available for you. And I think it just gives you the opportunity to sink your teeth into the material a little bit more. Now, I don't know what your backgrounds are yet with financial accounting or managerial accounting. I know that a few of you have responded and said that you're looking forward to the course and that some of the material seems to align with what you're doing or what you plan on doing. So that's good to hear. My hope is that even if you're not using this material specific to a career path or profession, it's fine. But what's important to understand is finance really is the heartbeat of any organization, and everything that happens in an organization funnels through to the finance and accounting department. It really does. You have payroll there, you have purchases there, you have sales recording there, you have banking there. Everything is there. And so it's really good to know the language. It's good to understand what data is being produced. Like what can I get as a production manager? What use would accounting information have to me? Well, actually quite a bit. You can set metrics, you can set dashboards, you can set all sorts of things. But you just need to know what that is that you are trying to do and what you're trying to measure. And so the first part of the course looks at financial accounting. And the financial accounting is really looking at, well, basically the financial statements. And we'll be looking at a set of statements. Tonight, I'll show you an example of a really nice set that I'd like to use. And the other thing that I'll be doing is I'll be posting a video for it. It's about 45 minutes. It really just looks at the concept of business, like just in general, just things we need to know, whether you're an accounting background or not, and what sort of the underlying mechanics are, and things that we need to know outside of just knowing the business. There's lots of other external factors that play a big part. So I'll be posting a video for you on there, and some of my slides are tailored to that video. So are there any questions about the course outline at all at this point? I don't know if you've had a chance to read through it or not. That's okay. Best way to get a hold of me is email. And I'll respond. Hopefully I've got so many email accounts. I'm supposed to be notified when I get the email, so hopefully that works. If not, I usually get back to you early in the morning or later at night, if not during the day. And if I haven't responded in 48 hours, just nudge me, just say, just following up. And I'll go, oh, right. Yeah, it's been a bit busy. Anyways, okay, so I'll leave it at that then. And so everything that I post will be here in Moodle. So when this Zoom session is done, I will be posting it here in week 1. And so I think, let's see, what can I do here now? I'm going to stop that. That's the course outline and the website. What I want to do now is I want to, I just need to remember where I put it. I have so many tabs open. Yes, that's the one there. Okay, so what I wanted to do, instead of going through PowerPoint slides and, really just talking about the blah, blah, blahing of financial accounting, what I thought would be more interesting is to actually walk you through a real set of financial statements. And the reason I'm doing that is because I want to introduce you to the course in a different way, and maybe something that is more relatable, maybe for some of us. But I do like these statements, and you'll see who it is in a moment. So the financial reporting is going to be very interesting in the next fiscal for companies that haven't reported since March of this year. And what we'll begin to see, of course, are conversations about COVID and how it impacted their business. And I remember when COVID, when the transition came in mid-March, when they started all the lockdowns, I was having a class very similar to this, and we talked about what's happening in the boardrooms. And what was happening in the boardrooms was, what are we going to do? We're shut down, and we have employees to pay. We have communities that we service, and we're not, especially if you were a non-essential service, this was probably wearing a lot on the minds of management and senior management. So they were in the boardroom and they were recalculating their budgets. They were looking at break-even analysis. They were looking at how are we going to rescue this year? That's what they were doing. So a lot of these financial statements will begin to disclose this, and management discussion and analysis, management information right here, is where you will see that, and you'll find that. Now, Aritzia is not quite in the cusp of COVID and their financial report that we'll see here. We'll go to their annual report. This is a fiscal year of 2020. So fiscal year is basically, whatever that 12-month period is for their financial reporting. So it could be any year end. This is a corporation, so it can be any year end that it wants. It does not have to be January to December. It could be any time it wants. And the reason I pick Aritzia is not for the fashion, because I don't shop there. It's a really interesting company though. And the reason I like it is because it is based in Vancouver. It's a Canadian company. The head office is in Vancouver. It was started in the early 80s by a local family, which was a really small kind of boutique kind of shop. And it grew. And now it's a publicly traded company with lots of stores across Canada and in the US. They've expanded into the US. So it's grown a lot. But when you can imagine COVID hit, that this was probably greatly impacted, and it was. They had to shut their stores down. And so why do I use Aritzia? Well, because it's Canadian and because it's local, and they've done quite well. But the biggest reason, apart from those great things, is that they have really nice statements, and they're really nice statements to teach from. And so that's why I use them. There's a great story. This is the chairman. He's the founder. His family was the founder, but he's still the chairman. And so he writes this great letter, but you can see here, there's a COVID-19 response here. And they've addressed it, and a lot of financial reporting will address this, and they're going to be very transparent, because what they're trying to do is tell users, you and I, how they plan to remediate all the losses. Like, how are we going to manage this going forward? In March, I think we thought of this as a short-term thing, like it's 6 to 8 months. Now looking at it, what's happening, we're going to see another year, year and a half, maybe 2, I don't know, until we can actually get back to full swing. So it's a little longer term than I think we all imagined at the beginning of February, March. So you're going to see a lot of these companies address this. They talk about what happened. They closed 96 of their boutiques. That's a lot. And what they've done in the meantime, and how they're going to build this business back up. So we get a sense of what management's thinking. And this is important because think of yourself here as an investor, and maybe Aritzia appeals to you and you would like to invest in this company. So if you're going to do that, you need to have some financial acumen, right? Like, why would I give my money to the company? Well, because I want a return on my investment. I want some sort of dividend, which is the normal case. So if that's the case, then I need to understand what the potential is for the company to pay me a dividend. And that's why I need to know this. I need to know these terms and the terminology, and really what the statements are telling me. The statements will tell me one thing, but management here, right, is going to tell us what else we need to know, which is outside of the financial statements. So you have to balance the two together, balancing the management analysis or discussion and what their perspectives are, where they see the company going in the short and long term. That's giving us all the external information. The accounting, the financial statements is giving us information, but it's past information. It's already happened. So when I see these statements, which we'll get to in a moment, it's past information. I can't do anything with it going forward, but I can use it and I can establish trends. And we'll go into what these statements are really trying to tell us. But I begin with this because it's presented first, but also because it's management is telling us and giving us some assurance that, you know, they're really working tirelessly to build this business and keep it going. The last thing that anyone really wants to do is close their doors. So they talk about what they did during the pandemic. So I'm just going to really scoot way down to the financials here. So these are the consolidated statements. You'll notice their year end is March 3rd. So it was just before COVID hit. So we're going to see some really nice financial statements. 2020 is probably not going to be as good for them, like 2020, 2021. So the reason you saw the discussion from management about COVID is because the statements were finished and then management prepares the reports after the statements are done. So they were well into COVID when that report was written. So that's why you're seeing it there. But we're looking at a March 1st, 2020 year end. So that's what we'll be talking about. So one thing you'll notice on the financial statements is the auditor's report. And this is mandatory by the regulatory bodies for publicly traded companies. They must have audited financial statements independent from the organization. And the reason for this is because I don't have access to management. I don't have access to the company records. I'm a shareholder or potential investor, or I could be a creditor, which means I would like to lend money to you, but I want some assurance that you would be able to pay me back. Okay, so we need an auditor's report. You'll notice it's called an independent auditor's report, which means they should not have bias. They should not have any partisan relationship, nonpartisan, independent from the company. Clear second set of eyes. And what the auditors are doing is that they're going through, they're testing, they're sampling, they're asking management questions, they're looking at internal controls, they're really assessing the whole financial system within the company. And this is giving me, the user, potential shareholder or creditor, some level of higher assurance that whatever is in those financial statements, I can depend on. I can make good decisions with that. Now, auditors, you know, don't misinterpret this. Auditors do not look at every single transaction. That would cost way too much money. But what they're doing is they're sampling, they're giving us a level of assurance. Okay, so don't come in here thinking they've looked at every single thing. That's not true. But they are looking at most things and looking at the systems that are in place. So the auditor here is PricewaterhouseCoopers, PwC in Vancouver. And they've said, in our opinion, okay, so their consolidated statements, everything looks great, okay? Its cash flows for the years, et cetera, ended in accordance with IFRS, which is the reporting guidelines. Then everything looks happy. They're happy with the statements. So as a user, I'm happy to see that. There's no concerns whatsoever. How did you base your opinion? Well, how did you do your audit? We looked at Canadian auditing standards, okay? And they talk about what the responsibility is for the audit of this report, okay? The audit evidence they obtained is sufficient and appropriate to provide their opinion. So they've looked at really credible data, okay? They're independent, they must disclose that, okay? And it's an ethical thing to do, which they talk about. They fulfilled the ethical responsibilities in accordance with the requirements. Okay, so that's a really good front page statement to the financial statements. And then they go on to talk about other information. So what they're telling us here is that, you know what? Management is responsible for one part of the information and we are responsible for another, the financial. Basically what's happened is management has prepared the financial information. The auditors are not there all year. Management is, and they prepare the statements, okay? The auditor comes in and provides assurance that those statements are, for lack of a better term, true and correct, okay? That they're prepared in accordance with IFRS, International Financial Reporting Standards. So the auditor then expresses their opinion, but they're mentioning here that we are independent from management. And that's what they really have to make sure they are clear on. Because if there's no independence, there's problems. You may have heard about a very famous fraud called Enron. What happened then was back in 2001, the fraud was discovered, but this was going on for years before that. But they had a really very, very, what's the right word for it? They're the top five. There were 5 firms, big 5 firms. Now there's 4 because this firm no longer exists. So it was Arthur Andersen. It was a huge accounting firm internationally, and they were the auditors for Enron. And to make a long story short, Arthur Andersen facilitated the fraud. They were paid an exuberant amount of money to audit the statements, to carry on the fraud. And so they were providing pretty much illegitimate audit reports because they were being paid. There's a kickback for them to provide assurance, and they got caught. They did jail time and they are no longer around. So that's the end of that bad decision. So we do need to establish independence. That's why it's so important. And then it goes on to talk about responsibilities of management and those charged with governance for the company and their statements. So they go on to talk about who's responsible for what, who establishes controls. Basically, the company is responsible for that. The auditor will come in and they're like, hey, you know, your cash controls are really weak. We're going to make a recommendation. So they do. It's up to management to incorporate them. And if they don't, the auditor writes a note saying, hey, we told you this last year, you didn't do it. Now our opinion is going to change because we can't verify, we cannot trust the information, okay? The weak internal control. So the risk of the audit goes up. And so when we talk about the responsibilities of the auditor, what did they actually have to do? Who needs a textbook when you've got it right here, right? So what does the auditor do? Well, they're going to provide reasonable assurance right here about the consolidated statements, if they're free from material misstatements, if there's fraud, and they're going to issue a report and they're going to tell you what they found, okay? And then so what they're doing is they're saying, this is what we're doing right here, okay? That's our job in a nutshell. So it's quite a few things, but this is good disclosure for someone who doesn't really know what the audit process is or what it looks like. And so you can imagine this is why it takes so long. This is a public company. There are multiple locations over the border, US and Canada. So it does take some time to audit consolidated statements. So that's what the auditor does, and that's the responsibility. The other interesting thing here is that the engagement partner who's in charge of the audit is listed. So if there's any issues, you know who to contact. And this was done this year in Vancouver. So what are these statements? Well, this is what they are. I mean, they may not make a lot of sense right now unless you've had some experience with them in the past, but they just look like a lot of numbers with some text beside them. But they are actually telling a story. Financial statements are like a storybook for a company for a fiscal year, and they actually tell us a lot of things. So I'm gonna start with another statement because I don't like starting with this one, and the reason is because it's the last statement that's normally prepared. So I'm going in order that they are prepared to make more sense of what we're talking about here. Now, this is one of the statements I like to go to first. It is the income statement. Why do I want to go to the income statement first? Statement of operations, because it tells me net income. That's what I want to know. How much money did they make? Right? So I don't know if that's good or bad, but what I can tell from this statement, from net income anyways, is that it's more this year than it was last year. So for an investor, I'd be, hey, that's good. They're retaining more income for me, the shareholder. And so I can go line by line. You'll notice that they're always comparative. Financial reporting standards say you must compare your results. It has to be at least 1 year back. Some would agree, but most time it's 2. Because we need comparatives. We need to assess improvement. So last year compared to this year, much better. Last year compared to this year, a little higher, but that's because revenues went up. So cost of goods sold is really the cost of your inventory. So if that's going up, oh, you just put your microphone on. If that's going up, that means that sales have gone up. So that's a good sign for us, but they kind of go in tandem. So we see gross profit here. Now, gross profit is telling me that this is sales less my cost of sales. That's how much money I have left over to cover the rest of my operating expenses. That becomes a very important concept later on, okay? The higher the gross profit or gross margin, the better. So when we get into more of the analysis, we'll start converting these into percentages. So as a percentage of sales or net revenue, what does that look like? And a safe place to be is around 60%, okay? So you know what, I'm just gonna do that really quickly now because I'm really curious what it is. I like the company, but let's just see if they can get a really good gross margin. There we go. And what were sales? 980, 589, okay. 41%, okay. So 41% gross profit, that's pretty good. 60 would be better. But what I'm really curious to know is, did I have enough to cover my expenses? So did I have enough to cover operating expenses, finance expense, other income came in, income tax expense? Oh, looks like I did. So I've got, you know, this is in millions. So it looks like we had a pretty good year. So the key here is, just for an overview, is that I'm wanting to look at comparisons last year to this year. And I'm going to be looking at these as I look through all of these statements. And I can tell that the company did better this year, financially anyways, in terms of net income. The other thing I can look at is this earnings per share. If I'm a shareholder, what are my earnings per share that are held? Well, 84 cents. Or if I dilute them, it's 81. That's pretty darn good. Okay, so I get a sense of where I'm at because I looked at last year's. Last year it was 70 cents, now it's 84. That's great. 67 cents for diluted and now 81. So this is good news. This is a really good, strong performance last year. Now you'll notice this other column here with a note. These notes you will find in the financial statements. And what the notes do is it sort of expands the concept here. It's saying, this is what's in net revenue. This is how net revenue is calculated. Okay, so we get an understanding of what underlies this figure and how it got there. So we'd always refer to the notes for more disclosure. That's comprehensive income. Here we have, this is a really complicated example of retained earnings, but this is shareholders' equity. And really what they're doing is they're showing us the differences between net income, stock options. Remember, this is a consolidated company. And foreign currency translations, etc. What I would like to draw your attention to is retained earnings, this one right here. Because retained earnings is something that is important to shareholders, because it's just that, it's their earnings, corporate earnings that have been retained. So retained earnings. And what we're trying to do with that is build it and build the wealth of the company. So at some point in time, I can distribute them to the shareholders. So I'm retaining them for future distribution because the earnings belong to shareholders. Okay, so how do I get them to shareholders? I declare dividends, and they're paid in dividends. It reduces retained earnings. So I'm just finding this account on this, like it's on hold. Earnings are on hold, or they're retained for future distribution. So that's sort of why this account's really important. And as we go through the course, you'll see, you know, what that looks like and how it creates this balance, and how it decreases and how it increases. But basically what we're doing is we're saying, well, let's prepare the income statement. We'll close all the accounts out. We have net income. We're not distributing it this year, so put it into retained earnings. Great, it goes into retained earnings and it sits there and it sits there. And maybe 3 years later, the board of directors declares a dividend. Great, cash dividend. We're going to spend all of this retained earnings. As long as we have enough cash, we can do that. So increases to retained earnings is income, and anything that reduces retained earnings, either a loss or the payment of dividends. So we just want to keep an eye on what kind of activity is happening in retained earnings. And these ones are giving us a pretty good indication of what that looks like. So last year and this year. But this is a bit more complex than I would like to show at this point in the course anyways, but it gives you a sense of what that could look like. So I'm going to go back up to the balance sheet because this is where there's a lot of activity. This probably holds a bit more weight than the income statement, because actually retained earnings is included here under shareholders' equity, but and also included in retained earnings is net income. So why is this important? Well, let's look at the characteristics. It's comparative. There are no disclosures. Okay. It's got a date on it. Great. We know what it is. But the interesting thing about the statement of financial position, or the balance sheet, is that it balances. Okay. So assets equal liabilities plus owner's equity or shareholders' equity. And this is the long-term statement. This is where the entire life of the company is recorded. It's all the history, all the transactions are here. The income statement is 1 year's worth. So at the end of that year, it's going to turn off and start again, kind of like a score clock, you know, a hockey game. 3 periods of hockey, end of the game's done, great, reset to 0. That's what happens on the income statement. So it's only alive for 1 year. The balance sheet, or the statement of financial position, on the other hand, is a living statement. It doesn't zero out to anything. It just keeps going and building. So this is why it becomes more important to pay attention to, because we can start to look at the very significant changes, or, you know, maybe none at all. But one thing you'll notice here is the categories. So I told you that it's a balance sheet, and so assets will equal liabilities plus shareholders' equity. And if you look at this here, the total assets is 1,036,000 and change. You'll see that's also 1,036,000 and change down here. So they do have to balance. Okay, that's the whole idea of accounting. We like to balance things out. So when I look at these categories of assets, current assets and current liabilities for that matter, these are all short term, within 1 year of the financial statements. So I expect that my cash and cash equivalents will probably change on March 2nd. My year ends March 1st. That was the value at that point in time, as at March 1st. Okay, so right here it says as at March 1st and March 3rd. So at that date, that's what the balance in the bank account was. Okay, next date will probably change, but this is why I said it's past information, but we still use it. What I'm interested in, though, is looking at the comparative. We have more cash this year than we did last year. We have more receivables than we did last year. Well, that's good. Our sales went up. So that kind of makes sense that we'd have a receivable sitting there from a customer. Some other increases and decreases. So they're kind of all over the map. But what we can really tell is what increased and what decreased. Okay. And is it important? Well, the operating activities, or sorry, the current operations, like current assets and current liabilities, that's the everyday operational. I sell things, I pay my bills, I have payroll. It's kind of the everyday stuff. So I want to really know, and we'll be able to do this later on, how well I can manage my current assets and current liabilities. And there's a couple of financial analysis tools that we can use to tell us a better story, because the numbers are one thing. But if we turn these into percentages, it kind of gives us a bit of a different story. But for now, it looks pretty good. Assets, long-term assets, property, plant, and equipment. These are long-term, and we'll look at these later on in the course. And what this is saying is, I bought these really expensive machines, and I'm not going to use them in 1 year. I'm going to use them for 10 years. So what this is telling me is I've got these long-term assets sitting here. Well, looks like I didn't have a right of use asset last year, but I do now. This one stayed the same. It's goodwill. It won't change. We don't amortize it. These ones have decreased and some have increased. So it depends on whether I bought new assets or if I've depreciated them and not replaced them. So we don't know until we look at the notes. But they're long-term assets that we use in the business for a long period of time. So I can't expense them when I buy them. I depreciate them and I prorate that depreciation every year. And we'll study more about that later on. In terms of long-term liabilities, we're looking for ones that, well, obviously are not current. So anything beyond 1 year of the financial statement date. So your loan payable, bonds payable, mortgage payable, the long-term, 3, 10, 20 years that you may have sitting on your balance sheet. Pension liabilities can be quite large liabilities on some financial statements for some companies. So again, we just see these in, just a longer term scope where it's not going to be used up in the current year. So they're going to be with the company for a long time. And if I see that on the financial statements, I'm thinking, well, they've got these payments that they're stuck to because they're contractual. So I have to think of cash flow, what that looks like. And the bank will definitely be looking at those. So we might want to think of a debt ratio later on to think about and demonstrate whether or not this company is capable of making regular debt payments. Now, the last part on this statement of financial position is equity. And equity basically consists of shares, common shares, preferred shares, retained earnings, which we talked about earlier, and then this contributed surplus. Contributed surplus, I'm not really too worried about. I'll tell you what it is, but you won't be expected to do any transactions with it. If a company buys back shares from its shareholders, it may result in contributed surplus. We may have paid more for it. So the company is actually contributing to this equity in another way outside of the original transaction. So we just record what that looks like, and it's gone down quite a bit. So that's good. So the directors sign it. Brian Hill's the chairman. Another director of the board. It's probably chairman of the board, or no, John. I think Brian's the chairman. I don't know what John is. Anyways, they've signed it and off they go. So that's 3 statements. There's one really last important one, but before we go there, what I want you to do is I want you to remember this number here, cash. Okay, cash and cash equivalents. So this becomes really important because as an investor or creditor, if I'm going to invest in this company, and if you remember anything from tonight, remember this. Get ready. The reason we're assessing or looking at these financial statements, yes, they're past information, but what I'm really trying to do is assess the ability of this company to generate future cash flow, period. Can this company generate future cash flow? And if it can, I may invest or I'm going to lend money. But how do I know that? Well, we'll start to look at these line items. We'll start to look at comparisons. We've looked at the revenues, right? We've looked at the increase in revenues, the increase in retained earnings. So far, so good. The balance sheet doesn't look that bad, but we need to do a bit more work, and we will later on in the course. So how do we know if a company can generate future cash flow? Well, let's go see how they use their cash. Okay, so they're telling me that at the end of their fiscal year, on March 1st of this 2020, they had 117,750 million. Okay, that's how much was in their bank account, consolidated, of course. So remember that number, write it down. What I'm going to do is I'm going to go to the fourth statement here, the most fun. This is the story. This is the story of cash. And it's the story about how cash started and ended this year. What I want to know is, how did cash move? How did it flow? How did management use or provide cash? They are the stewards of the cash. And if I'm trying to assess future cash flow, or the ability for the company to generate future cash flow, I need to know how they're spending it. It would be really good to know that. So it's not a guarantee, but if they're managing their cash well, then there's potential. Okay, there's a better ability for me to, have some assurance or reliance on their ability as managers to give me future cash flow. That's what I need to know. So the cash flow statement is just that, cash. Anything that is non-cash will not be here, period. So the operating activities that I see here is the first category. There's 3 on the statement: operating activities, financing activities, and investing activities. Okay, and we'll explain what each of those are now. Starting with operating activities. They start with net income. They use the indirect method, which is just an easier way of doing it. And so what they're doing is they're saying, hey, you know what, depreciation isn't cash, I'm going to add it back. There's a finance expense that really wasn't, anything to do with cash. So it's just a book entry probably. So I'm going to deal with it here. And some different types of expenses. So don't worry about those. Those are really, they're operational, but they're a little bit complex for our purposes here. But what they're really trying to do is trying to reconcile cash and non-cash items off the income statement. What happens here down below is I see some very operation type transactions, okay? And what I'm trying to do under operating activities is understand how the current assets and current liabilities have changed. How did they use or provide cash for me this year? So operating activities gives me current assets, current liabilities, and the change between the years. So that's why I have comparative numbers. I can identify the difference or the change. And what I have to think about is, where's the cash? Do I have it or does somebody else have it? So I need to know how management used or provided the cash. Here, what we see, based on operating activities only, net cash generated from operating activities. This is a positive balance. What that means is cash was generated or cash was provided to the company through operating activities, okay? The opposite would be that we used it, but in this case, we have it. It's being contributed, okay, or generated or provided. So that's a good start. Next, let's move on to financing activities. Financing activities, you will find all of these activities, these line items in the long-term liabilities section of the balance sheet. That's where you're going to go for this. So I know in my mind, the long-term liabilities is reflected here in terms of how cash was used or provided. Okay, so what do? They repaid a lease. Okay, that makes sense. Money went out the door. Proceeds from options exercised, those are shares. So I got money in, proceeds means cash in. Shares repurchased for cancellation. Oh, I spent some money, 107,560 in millions. And nothing else for the other 2. So I can tell that I've paid out these 2 items here and I've received cash for the proceeds from the options. So sometimes share options are for employees and they exercise their options and they give cash to the company for shares. So this is telling me a story. Long-term liabilities. Okay, well, I paid down my debt. I received, means I issued shares, but I also received cash for them. And I repurchased some shares. So that's giving me some information. Why would a company repurchase its shares? There must be a strategy there somewhere. So I know how they've spent or spent being used or received or provided cash. What I see here, the net cash used, it's negative. Used means spent, okay? So in operating activities, I was provided cash. For financing activities, I used cash overall, okay? But it's okay, we're supposed to pay our bills, right? And we might have to cancel some shares. We had extra cash, we could buy them back from the shareholders. That's okay. The last category is investing activities. And the reason that these are important is because think to the long-term assets section of your balance sheet. So it's the last one. I mean, there's only a few, and this is the last one. So long-term assets on the balance sheet. This is where you'll find these transactions. So let's take a look at the line items. There's 2 transactions that used cash. They bought or purchased property and equipment. Okay, cash went out the door. Purchased intangible assets. Again, cash out the door. So you're probably thinking, wow, they're really spending a lot of money. That's okay. You need to spend money to make money sometimes. But it's not bad to spend money because this equipment that they're buying, these other assets, are being used to generate revenue. That's okay. And I'd rather see a company purchase assets than sell them, unless they're repurchasing new ones. So if I were to see a different story here to be concerned about, I mean, in this case, it looks good. The net cash used in investing activities is fine. There's 2 items. What would concern me is if I saw a pattern of liquidating assets and not replacing them. Because what that means to me is, especially if cash up in operations was negative or used, and we're selling off and liquidating assets without replacing them, that would be a red flag for me, because why are you selling your assets off and not replacing them? It probably means there's a cash issue. I want to see cash flow through the company. Okay, if it's not, there's a problem. It could be a number of reasons why, and we'll talk about those in the course. But remember, I told you to think about that cash balance, right? So what we're going to do once we finish all 3 categories is we're going to look at the effect, that's exchange rates, but the increase or decrease in cash and cash equivalents. So what we're doing is we're taking the 22.76 less the 157.402 less the 47.790. So I'm just netting these 3 categories out, and I come to the 16,853. Okay, it's an increase in cash and cash equivalents. Now, my cash at the beginning of the year was 108.97, and look at this. There's my cash and cash equivalents at the end of the year. So what this statement does is it explains to me how cash was used from the beginning of the year to the end of the year, and that relates to my cash balance. It reconciles to that cash balance. I now see the story as a user of these statements. What is it telling me? Well, it's telling me that I'm paying my bills, I'm buying assets, I'm generating cash from operations. That's a good sign. These are nice statements. And the fact that it has a really clean audit report, it's generating positive cash flow, it has a pretty solid balance sheet, and it's generating net income. Couldn't ask for something better. It's doing well. Now, this was last year. Remember I said earlier, the purpose of these statements for users is to assess whether or not the company is capable of, or what is the chances that the company can generate future cash flow. That's what I want to know. Well, I think looking at Aritzia's statements from this year, it looks good, but I know COVID is out there. I know it impacted sales. What is it going to look like next year? Now they issue quarterly statements, so you can go and look, but the bigger picture is probably better. The not that it's a great thing, but the level playing field amongst the world is that this impacted the world. It wasn't just one economy. It wasn't just one country. It was global. And so most businesses have been impacted, okay? And you'll see these in the financial statements. So the question comes, what's the viability? What are the chances of these companies generating future cash flow? Well, the financials might not be as convincing. It's go and see what management has planned. Go and read the management discussion and analysis at the beginning of the annual report and hear what they have to say. They have to say it because it's getting really competitive now. They need to survive. It's not about making profits. It's not about declaring dividends. It's about keeping jobs. It's about keeping communities. It's about, maybe revisiting or reimagining how else business can be done. And if anything good comes out of this pandemic, maybe that's it. Maybe it's realizing the potential of what we're absolutely capable of and how we change our business practice or our business model. Could be better or worse for some, depending on the industry. But it really gets you thinking about what else could it be? And is this something we ever go back to? And if it's not, how does that impact financial reporting? It's a good question. I guess we'll soon see in the next few years. The last thing I want to point out is the notes. These are the notes to the consolidated statements. You saw those note numbers beside some of the line items in the financial statements, and this is where they are. So if you want to look something up, this is where you come. The first note is always the most interesting. It talks about the company. What is it? It's an innovative design house and fashion boutique. What it does, what its brands are. They had 96 boutiques as of the end of the year. It's governed by the BC Corporations Act, where it's registered, head office, etc. And then they talk about what they've done probably in the most recent year. That's a really long note one, longer than I've ever seen before, but it also talks about the exchange that they're trading on. So one other thing too that I forgot to mention when we were reviewing the auditor's statement and the auditor report is that the regulatory bodies like the Securities Exchange Commission also has mandatory filing of financial statements quarterly, and also they have to be audited financial statements amongst other regulatory filings. So they do have to remain in accordance with those in order to maintain their position in the market. Otherwise, it can be rescinded. So they talk about how their year end is really odd. Most people just pick a date, but for some reason, it's the Sunday closest to the last day of February. It's really bizarre, I know, in a 52 week. So 52 week year, or it could be 53, whatever you want. But as long as it's comparative, it doesn't really matter. It's around the same time of year. That's why the dates always fluctuate by a day or two. So it's just unusual. You don't see that very often. And then they talk about the standards. So I'm not going to go through the notes with you. You can do that on your own time if you're interested. All you have to do is Google Aritzia financial statements and you'll find the link to the annual report. So that's kind of what I wanted to do this evening. Rather than going through PowerPoint slides, explaining, one after the other what the statements are, I want to show you a real set of statements. Now, when you go back and do your readings and walk through a lot of that material, you can link back to these statements and understand what they're trying to tell you and why they're important. You won't know necessarily all of the line items. We do work through those throughout the course. So it's just a matter of what is happening here. Okay, what do we have and what are we looking at? And the other thing that we'll be talking about when we meet next is how these statements come to be and what does that economic transaction look like that gets these statements to where they are. if you can really conceptualize like a grocery store, if you think of the last time you walked into a grocery store and I asked you, what did you notice about it? I get a lot of different answers, actually. Or some people are like, I've never actually thought about it. I just go shopping. Or that you're there so much that you don't really think about it. For some, after a discussion tonight, it's like, oh yeah, that's right. So what I want you to think about is, how does a grocery store compare to financial statements? And what I mean by that is just trying to find a way to contextualize it. So if you walk into a grocery store, they're very strategic, by the way, they do a really good job of this. You're usually walking in near the bakery or a flower shop or where they prepare food because it smells really good and kind of just draws you in. And you just kind of want to stay around for a little while and take it all in. So that's why the front entrance door is usually near one of those places, okay? Anyways, so we're walking through the store, and as you're shopping, as you're looking through your list and you're going to find what you need, think of the structure of the store, okay? And I don't mean the internal controls, we'll get to that, but the food, the other items that you would buy, where are they? So think about where you are going in the store. Well, if I want bananas, I go to produce. If I want eggs, I go to dairy or refrigeration. If I want something frozen, I go to the frozen section. If I want bread, I go to the bakery. If I want pet food, I go to the pet food section. And on it goes. Why is it that way? Well, because it's easy to shop. Everything's in categories and it's easy to find. Okay, if things are in certain lanes or aisles, you'll remember, okay, aisle 9 is pet food. And it's done for ease of use, and it's done, there's other psychology pieces behind it about why it's done that way, but there's a sense of order to it. So this order is reflected in financial statements. Think about how these statements are categorized, right? So if we took current assets, we would say, all right, anything that's current within the year. Well, I look at accounts receivable. I make a sale and my customer says, put it on my account. And I've got 30 days to pay for it once it comes due. Okay. So that's great. Well, what do I do with that transaction? Well, when we're building these statements, this is the end result. During the year, we have all of these transactions. So really what I'm doing is I've just increased my sales. And how did I increase my sales? Well, I took a receivable. My customer promises to pay me, and I sold some inventory to do that. So I'm looking at these transactions. What do I have and how did I get it? And this is what's in the statements. So when we meet next, we'll be talking about what that looks like in terms of moving the shelves around, okay? And how do we get to this point? Now, I'll give you a couple of days to sort of go through, get your feet wet, get through the book, get into Wiley Plus, and make sure you have that ready to go. And once you're in there and in that program, then you'll be able to see, that I'll provide links to certain videos or make recommendations, and you can go watch them. But if you follow the chapters, it's pretty straightforward, and they have a lot of great material in there as well. So, and the great thing about it, it's available 24/7 at your fingertips. So hopefully this has helped. I'm going to stop sharing my screen here for a minute. Unless there's any questions about the statements, I'm happy to stay on this website. They're easy to find. All right. It's a really interesting company. I don't shop there. I've seen their stores. I've just never been in their stores. And so that's all I had to say about Aritzia. I'm just trying to think if I've forgotten anything.
Yeah, one quick question here.
Sure.
I saw a term called IFRS. What does that signify?
Yes. So IFRS, that's a great question. IFRS is an acronym for International Financial Reporting Standards. So in accounting, what we do is you'll notice that the financial statements for Aritzia are prepared in a very specific way. The balance sheet, the cash flow statement, it's very organized. Well, accounting standards tell us we need to do it that way. So we don't have it's not law, they're just guidelines. And so International Financial Reporting Standards is one of those standards, one of those bodies. So if you are publicly traded, you will most likely be using international standards because you're in the open public market. The US is not following International Financial Reporting Standards. They have the old US GAAP. So if you look at American companies, their annual reports will say we follow US GAAP. So most countries use International Financial Reporting Standards, but the US has decided they're not going to do that yet. So it makes it really challenging to compare US companies to others. Not that it can't be done, it would be so much easier if they just transitioned to IFRS. Maybe they'll come around. So anyway, so it's a very specific set of standards that requires companies to report in a certain way and method and disclosure. And so you see consistency among all IFRS reporting companies. If you were a privately held company, you would probably not, you could use IFRS, but you don't have to. We have another set of standards called Accounting for Small Private Enterprise. ASPE is the acronym. And so they don't need to conform to an international set of reporting standards because they're not presenting internationally. They're privately held. They don't change much. I mean, the format will be the same. It's just a lot of the disclosure is different. How we report something might be a little bit different because of who the users would be. The standards are meant to give useful information to users. So I should be able to understand it. Anyone who's not financially proficient should also be able to understand it. They might not know the terms, but they can read it and it's consistent, it's comparable, and it's faithfully represented. We have all these characteristics of this framework. And so not-for-profits are another example of a set of standards. They have Part 3 of GAAP, which they still use as not-for-profit accounting. But if it's the Red Cross, they're probably going to use international standards because it's an international organization. So in most cases, if it's international, like an international organization, or it's publicly traded, they'll most likely use IFRS. So it's just a way of, and I think the book kind of introduces IFRS and the different ways to report. It doesn't go into much discussion about it. It talks about the conceptual framework about it, but that's about it. We don't go into the standards here in this course. It's another course actually all on its own. So, but just remember that we don't have law in accounting. We don't have to do it a certain way. We have guidelines or standards. And for the most part, if you're going to report financial information, you will not deviate away from those standards, but it does happen. You will see some companies, actually 60% or more companies now do this. They report non-GAAP, and non-GAAP means they're outside of the standards. And the reason for that is because they just feel that they can't present the information in any other meaningful way. So they have to go outside of the guidelines, outside of the standards to really report the true essence of that transaction. And that's a problem because it becomes less comparable to other companies. It's inconsistent from year to year. And one of the conceptual framework characteristics is that statements should be comparable. And if you use non-GAAP reporting, which means you're outside of the guidelines, you just minimize that. You compromised it. So it's another discussion, but IFRS has some ways of dealing with that. They didn't like it at first, but it's kind of like the cell phones in classrooms. If you can't beat them, you join them. So they kind of decided that we can't get rid of non-GAAP, so we'll just put disclosure on it, and we'll make you do a lot more work if you want to use it. So that's kind of what they're doing. I'll be posting some videos for you that give you some insight into what IFRS is and what it means. That was a great question. Thank you.
I just have
Oh,
I just had a question. I just wanted to confirm. I think I already know the answer, but I just want to confirm that the only text that we need to have is the survey of accounting. I purchased the ebook version, and then once we get the information for Wiley Plus, it's just those two resources that we need, and we don't need the tools for decision making. Perfect. Okay.
no.
Awesome.
Yeah, and I posted the access code in Moodle for you, so you can access Wiley Plus with that course code.
Perfect. Okay, thank you so much.
Yeah, yeah. Let me know if you do have access issues there. Other question? Someone else had a question? No? Oh, I better heard another one there. Okay. All right. So if there aren't any more questions, that's sort of where I was going to leave it for tonight. It's always that bombardment on day one, but I just wanted to, have a chance to meet with you and, sort of go over financial reporting in general. As you get your feet wet a little bit with the material in the book, you'll maybe have some more questions, or once you've worked through some of the material, perhaps that will happen. But yeah, just giving you time to familiarize yourself with the materials. And I guess what I'll leave you with too is just to think about what day would work best to meet. It's going to be really difficult with everyone's different schedules. I would like to ideally leave it to a set day and time so we always know that's what we go to, but just to know as well that all the Zoom sessions are recorded. So you won't miss the lecture, you just miss the live version, that's all. But I would try my best to accommodate everyone. And if it becomes where there's 2 really great days, maybe we'll just alternate week after week. But that adds to complexity for the rest of your courses. So I certainly don't want to do that. But please just keep that in mind. Maybe I'll send a Google poll out or something, or Doodle poll, and get some sense of what that looks like for you. And then we can just move forward from there. Does that sound okay?
Yeah, one quick question here.
Sure.
Like, if we'll not be able to attend the live session, will that impact the attendance score?
No, because this is you registered for this course as an online course. So I don't like doing courses without meeting. I just like to talk too much. But I don't know that the attendance is really going to be an issue for me, because you're going to do the work regardless. If you can't make the seminar the day it happens, it's recorded for you. So you do have access to it. That to me is attendance. You are using the materials that are provided. So the fact that you're doing homework is attendance, like you are doing the work. It's just one of those things where it's an online course, and I like to give guidance as much as I can. It just might not be accessible for everyone at the same time. That's the thing. And so I know that when students sign up for online courses, there is no set time, which really adds flexibility to one's schedule if you're taking other courses that do have scheduled time. So I really don't want to interfere with those other classes. So yeah, I just want to try to see if we can find a time to meet that doesn't interfere with that for you. I'll do my best.
Thank you, Erin.
You're welcome. Thank you. Any other questions out there? No? All right, well, I'll stop recording that.